Well, hello again, everybody. I know it's been a while. Let's just say I've been busy. Anyway, I'm here today because Cryptoland has just been hit by yet another scandal. A top 20 crypto token by market cap Mantra Ohm was wiped out, losing 90% of its value. You can see that in this beautiful chart right there. We don't yet have a consensus about what exactly happened, but commentators are broadly agreeing that contributing factors include thin market liquidity, possible price manipulation, and a lack of transparency over circulating or floated token supply, market maker actions and terms about over-the-counter own deals, and own positions pledged as loan or trading collateral. If you want a closer look at these discussions, I heartily recommend this episode of The Chopping Block and this interview by CoffeeZilla with the project CEO. For my part, I normally don't do videos reacting to the news, but it just so happens that I delivered a webinar on risks in crypto a couple of months ago, and I spent a good amount of time diving deep into lots of the issues that are being discussed following Ohm's collapse. So I guess I get the unwelcome satisfaction of having my thinking and risk analysis be proved right by this event. Now, I'm going to play back those sections of the webinar to you in a minute. I recommend you watch it if you're interested in gaining a broader understanding about why token listings as a whole are a deeply shady business, and for you to understand all the unfair advantages that insider parties have available to them to rig the game against you. What happened with Ohm shows you what can occur when these strategies go badly wrong. But make no mistake, this reflects an underlying pattern of abuse that is widespread and totally routine, normally getting by under the radar. To shore up my argument, one of the things I do in this webinar is make a comparison between the regulations that typically apply for new equity listings on traditional stock markets versus what's typically done for token listings on centralized crypto exchanges. And when you compare them side by side, you really do see how the privileges that crypto insiders get are basically obscene. And to make things worse, the slivers of information that you get from major market data providers, which maybe could help you manage these risks a little bit, aren't worth the pixels they're printed on. There is no uniform or rigorous methodology to determine how many tokens are out there floating or circulating. And that means that there is no such methodology to determine a token's market cap. That's the figure they use to rank Ohm in the top 20. And as a cherry on top, there are no penalties or accountability for incorrect or fraudulent reporting of these pivotal financial figures. It's time to wise up. This anti-establishment CryptoPunk fantasy that you've been sold is a lie. You are not freeing yourself from the matrix by investing and trading in crypto. You are lining yourself up to be minced into market chum. Believe it or not, many of the market regulations in TradFi that so many people in this industry love to hate were created to keep you safe. Back in the 1920s, traditional equity markets actually used to be pretty similar to what we see in crypto today. And all the people running it back then thought that it was all pretty fine, and even had theory to back it up. If you want to read more about this, I highly recommend Taming the Street. Long and short of it, we have been here before, and it had to be fixed with regulations because appeals to self-regulation and the better angels of our nature got us absolutely nowhere. Anyway, without further ado, here are the live webinar excerpts, and I hope you find them useful and informative. That wraps up fair execution risks on decentralized trading infrastructure. Now that we know all of that, let's go back to reconsider the offering of a centralized exchange. Remember, they're not subject to MEV problems because the terms of each trade and their ordering are fully handled by their off-chain matching engine. Once that system matches orders, the terms of the exchange are set, and blockchain transactions implementing them will follow. Everybody has access to the same market information distributed by the operator, and the ability of participants to send orders is only differentiated by their internet connection speeds and ability to communicate with the exchange servers. Sure, centralized exchanges can choose which assets get listed, who gets admitted to trade, and so on. But if they're well regulated, those centralized powers won't be abused, right? So can we infer that all in all today, we can trust centralized exchanges to run fair markets? I'm afraid that the answer right now is definitely no. These markets are full of participants who are grossly unfairly advantaged and who routinely exploit that advantage in ways that fail to meet standards that we expect in traditional financial markets. Many of these advantages stem from the economics and norms of digital asset issuance. Yes, We do have insider trading risks. They're very significant, but those privileged insiders actually get lots more leverage from those inside information advantages thanks to the economics of digital asset issuance. So we're going to begin there. In any public market, traditional financial markets and blockchain alike, the issuers of a trading asset have certain advantages. Consider that in an ordinary market participant will only be able to acquire an asset or its trading pair for a direct financial cost. But issuers can create additional quantities of issue for zero direct marginal cost. Now, that misrepresents the issuer's broader economic position. They've already assumed various costs in order to create a marketable asset that receives trading interest, and issuers will eventually incur marginal cost to issuance from the damage that such issuance creates to the asset's value. However, for crypto issuers, we're going to see that those costs turn out to be far lower than they are for traditional securities issuers, and that loss is more than compensated by the upsides that this excess issuance generates. And all of this has helped to foster norms and practices around issuance and market listings that give insiders outsized tradable endowments, which give them scandalous advantages in the market, both upon initial listing and often in perpetuity. To understand how this happens, we need to understand how digital asset issuance works. The key steps for standard token issuance is that a set number of tokens is created, and they are divided into allocations, with some being sold to early investors to raise external financing. And the tokens in each allocation are released according to vesting schedules, which seek to align payoffs and incentives with the contributions made or required from each party, given the risks that they assumed with that contribution. This is done in a way that respects some high-level rules. The valuable tokens created at the initial listing price should be reasonable. They can't be higher than the entire world's GDP, for example. And supply should unlock gradually at a rate that reflects some plausible trajectory for demand from trading or from token use. And there are also some norms about the allocation sizes and accepted orders of priority for the vesting schedules. But all these are soft constraints that are ultimately dictated by investor expectations and market conditions. They shift around all the time. The two pie charts that you see on screen have become centerpieces for how early sale offers and new listings are marketed to investors and the public. The size of each allocation slice is intended to offer reassurance that parties to this transaction are only receiving their fair respective dues. And on this view, we typically see that the share of tokens going to market making, liquidity, and exchanges is maybe small, maybe 3 to 5% of supply. However, the vesting schedules mean that the proportions unlocked that are held by specific actors differs greatly at different points in time. If you zoom in on the listing date and the early trading period, the market making and liquidity allocation can compromise 50% or more of the tokens that are available for trading. And that's if the market making allocation is even disclosed publicly. And even though it looks like the market making share eventually dwindles into insignificance, the current norms around issuance accept huge amounts of tokens being endowed to the issuer. So although these tokens are stated to have various uses, their actual use is entirely at the issuer's discretion. There are no controls on accountability or disclosure to make sure they're used that way, and that means that they're all available to maintain an outsized advantage in markets. Let's just emphasize how different the crypto case is in comparison to a conventional regulated IPO. In a normal IPO, market makers typically get a limited allocation, often around 1 to 5% of the IPO issue, to facilitate price stabilization and orderly trading. In addition to that, the IPO underwriters are granted a greenshoe or over-allotment option, which allows them to oversell about 15% of the IPO issue and later repurchase those at the IPO price in order to manage post-listing price fluctuations. Exchanges are not given any issue to trade for themselves. So all in all, during early trading, these agents only had the ability to buy and sell less than 20% of trading shares if the full over-allotment allocation is used. But actually, that greenshoe option only lasts for 30 days. So after that, it's just the market makers with their hands on 1 to 5% of trading shares. And throughout all of this, all parties are strictly monitored to guard against market abuse practices. These numbers bear zero resemblance to the crypto case, where market makers handle 50% or even 100%, double the amount that retail users are handling. And exchanges themselves get a hefty endowment as part of their listing fees, and they also take part in the trading or sell them off to other parties. Yes, we could argue that token trading is much more volatile and that merits a larger inventory for price stabilization. We're in a deeply gray area here that provides easy cover for abuse. And just as a quick side note, These huge insider endowments are also very, very handy and effective for manipulating decentralized exchange trading too, since you can sort of shuttle tokens in and out of liquidity pools to provide favorable price execution for insider trades. So this isn't all about a lack of regulations. There are also fewer intrinsic constraints to larger crypto issuance as well. A traditional securities issuer would not be able to market excessive amounts of debt beyond the carrying capacity of their balance sheets or expected incoming cash flow. And in the equity case, there wouldn't be the ability to increase the issue beyond authorized limits without a vote by existing shareholders, since that act would dilute the value of their shareholdings. Now, these considerations don't apply in crypto because it is very acceptable for tokens to be issued and listed before the enterprise has any kinds of business. And these tokens go to market on vibes, vision, and hype. So to be crude about it, there's nothing to dilute in the first place. Most of the time, the market is everything in determining investor returns, not the underlying fundamentals of the business. And that means that dilution risks are much more than offset by the upsides that one can reap in the near term for market abuse. So I hope that gives you a comprehensive account of how digital asset issuance economics and the lack of constraining regulation gives incredible advantages to insiders and affiliated parties. As I said earlier, this amplifies the gains that they have available to exploiting insider information. Oops, wrong keys. And I won't say too much about insider trading because it's already very familiar to us from traditional finance, but I'll tell you one personal anecdote which illustrates how lax things are. I was once pitched to by a market maker who was proudly telling me how I could share positive news about my company to them ahead of time, and they would then go and create a giant green candle in the market shortly after the announcement to confirm positive sentiment around the news. Again, there are no restrictions or disclosures on insider trading of tokens that are not classed as securities at the moment. Supply matters. We have innate and educated intuitions about this. If something's easy to find or abundant, we expect it to be cheap. If the number of equity shares increases, their claim on a finite pool of assets, and all else equal, that increase dilutes the value of each share. Digital assets are no exception to these rules. And in fact, supply and scarcity have been a core focus of digital asset engineering from the very beginning. It costs us nothing to create a copy of a digital file. So it was a fundamental challenge for Bitcoin to overcome, to create an accounting system that made sure that you couldn't just copy tokens and do that in a way that was totally decentralized without a single person being in control. Now, that narrow technical concern mixed in with a broader policy position that Bitcoin should only ever have a finite supply of 21 million tokens. That choice was guided by theoretical ideas about sound money and served to strengthen Bitcoin's value proposition as an alternative to fiat currencies that could be issued without limit at the cost of long-term inflation. As a result, scarcity and finite supply have become very prominent to Bitcoin's narrative, and that, in turn, has elevated scarcity and supply to be prominent in the value narratives and token mechanics of digital asset successors as well. But several times, this focus on scarcity has gone too far. Yes, excess token supply undermines token value in both trading and fundamental contexts, but scarcity by itself does not create value. And this appears to be something that has been lost on projects that have tried to gamify their scarcity in order to make it a centerpiece of their narrative. There was a project called SafeMoon that would burn tokens on each sell trade made by participants in order to create supposed fundamentals that would only push the price upwards. That unraveled spectacularly, and some of the founders were arrested and put on trial. I don't know if those are wrapped up yet, but serious issues. Long story short, be very careful here and exercise added skepticism when you come across a project that is really, really putting a lot of emphasis into the deflationary characteristics of their token above everything else. We have more to say about supply. That's not all, because in a turn of events that I can only describe as an obscene irony, most of the time when you talk about a blockchain token, nobody really knows how many of them there are. Remember these two charts? The total number of tokens is given on the left. That quantity is openly cryptic verifiable under common token standards, but that number is not economically material because it does not refer to the number of tokens that are available to be freely traded at any given time. That other number is typically referred to as the circulating supply, and that's the number of tokens that's used to calculate the so-called market cap that is reported by every market data provider. facts about this number are communicated by this unlock schedule that you can see on the right there. But actually, how these unlocks occur operationally is totally irregular. Sometimes it's handled by smart contracts. In that case, the circulating supply is totally verifiable on chain, but many times it's not. It's just arbitrarily managed by humans manually. And some data publishers have told me that more often that's the case for new projects. Not only that, but once the tokens are unlocked for the first time, if they are relocked and no longer available for trading, those numbers don't get reflected in the market cap. And all of this means that the market caps that are being reported on data platforms are just validated by projects handing in a spreadsheet. No auditing or penalties apply for errors or inaccuracies. And can you imagine that kind of an uncertainty being acceptable for the reported market cap of a public traded stock? No. So, what's incredible about all this is that after all this tremendous effort, creating cryptographic cost assurances about Bitcoin's finite supply in a way that allows its circulating supply to be fully verifiable on chain as well as its max supply, we now have this whole universe of all tokens where nobody really knows how much supply is unlocked or available to trade, despite all of it being built on a technology that was designed to give us the ability to determine these things with cryptographic certainty, open and verifiably at near zero cost. This is where we are. Until we get regulation that standardizes the definition of circulating supply and its verifiable disclosure, we're going to have to work with the market cap data that we have. And you may need to do some extra digging to work out how reliable those figures are if it's material to your analysis or investment decision. So this is a pretty comprehensive toolkit now to get a purchase on digital asset value. And there are plenty more nuances that come into the picture when you're working with a specific asset or project, but we don't have time to do that. So I'm only going to look at one special case in particular because it is simply too important to ignore, and that's stablecoins.